You open a token chart, you see some green candles, active trades, big volume. It feels like the market is alive. It feels like people are buying, people are selling. Everything's moving. The ecosystem is working. But in reality, this isn't a market, it's a theater. And the main actor on this stage is the market maker. Today, I'm going to tell you how market makers create this illusion of life across the crypto market. Why liquidity is not the same as market cap. How to spot fake painted volume. And why price support ends up costing most projects much more than they expect. If you are new here, don't worry. I will explain everything in simple terms. And if you've been in a crypto for a while, you probably learn a few harsh truths that aren't usually said out loud. What a market maker actually does. Let's start with the basics. A market maker is not a trader. Their job isn't to profit from volatility, it's to create liquidity where there isn't any. They place orders in both directions, buy orders and sell orders. This makes the market seem alive. You can enter and exit a trade without the price crashing. When you see a thick stacks of orders in the order book, a small spread and fast execution, it means the market maker is doing their job. Without them, the market is empty. Orders just sit there and any large trade move the price by 10-20%. Its job isn't to move the price, but to make the gears turn without grinding to a halt. Liquidity is not the same as market cap. Many people confuse liquidity with market capitalization. A project can have a market cap of $500 million. That sounds impressive, but if there are only $20,000 of real orders in the order book, there is no liquidity. Market cap is a theoretical number. It doesn't mean the project actually has that money. If a token has 100 million coins and its last trade was at $5, then its formula market cap is 500 millions. But try to sell just 1% of that volume and the price will crash. So liquidity isn't about how many tokens exist. It's about how quickly you can convert them into cash. Real liquidity is the depth of the order book. It's the volume of orders at each price level. It's the speed of execution and the stability of the spread. Wash trading, fake volume. Now, let's talk about the dirty play. Wash trading is when someone trades with themselves to create the illusion of activity. Many projects do this. Even some exchanges do it, including such giants as Binance. Why? To show a lively market, attract attention and pump their ranking on sites like CoinMarketCap. Imagine a store where the staff pretends to buy out the inventory every day. You walk in and see the same products on the shelves. That's wash trading. Bots do this on exchange. Thousands of tiny trades bounce back and forth. The volume grows, but there is no real liquidity. To a newcomer, it looks like interested in the token. In reality, it's just numbers on a screen with no real money behind them. How this destroys the project? The problem is that fake volume works like a drug. At first, it's great, activity is booming, the chart looks alive, attention pours in, but soon the project gets trapped in its own illusion. Real investors start showing up and they see the disconnect. The volumes are huge, but the liquidity is thin. It's a clear red flag. Then the price dumps. Wash trading might help in the very beginning, but in the long run, it destroys trust and the coin itself. Because when the market turns real, the artificial activity is the first thing to disappear. Mint coins and listings. Let's move to the funniest part of the crypto market. Mint coins. Every day someone launches a token with a cat, a dog, or a frog. The price hits 100x, then crashes to zero. And everyone knows how it will end, but they still buy. Why? Because it's pure gain of speed and attention. Meme coins aren't about technology, they are about short term hype. The cycle is always the same: a stealth launch, viral tweets, early buyers, and then a sex listing. The next phase is just a test. If the token gets enough liquidity and traders, market makers join in. After the pump, it gets listed on a major exchange. That's when the team and market makers work together. They support the price, create fake volume, and manipulate the charts to make it look like there is massive demand. But the moment the hype fades and the market maker leaves, the price collapses. Real demand versus fake demand. So, how can you spot the difference between real demand and fake volume? There is a simple rule: don't look at the volume, look at the stability. If a token is pumping fast but the spread is jumping around, the order book is thin, and all the buy orders disappear on a dip, that's manipulation. Real demand is always distributed. It doesn't vanish in a second. Fake demand has sharp spikes, abnormal candles, and strange synchronized trades. Why technical analysis is useless? If the market is painting its own picture, how can technical analysis possibly work? On illiquid assets, any large trade can create a pattern. A flag, a triangle, a head, and a shoulders. You can create it all manually, just by moving the price a few percent. Many market makers use this to their advantage. And this happens not just on meme coins, but on major established coins in the top rank. They know that thousands of traders are watching support levels and chart patterns. So they move the price right to the point where the stop loss and large orders are clustered. Then they reverse. And here you go. The chart looks like it's straight out of a textbook, but the whole game is controlled and manipulated. Market making versus manipulation. Now, market making itself isn't a bad thing. It's necessary for the market to function. When a market maker just provides liquidity, that's a service. But when they start painting the market smooth, that's manipulation. The difference is simple. If the goal is to enable trading, that's Onyx work. If the goal is to control your perception, that's again with investors' emotion. The TRB and Teller cases. Let's look at some real examples. Take TRB Taylor, a classic case. First, a massive pump, crazy volume, then a wave of liquidation. Why? Because the market maker pulled it out. Taylor is a different story, but with the same ending. While the support was there, the chart looked healthy. The moment those orders were removed, the market collapsed. The problem is that many projects only survive as long as someone is providing artificial liquidity, not because of real organic demand. Binance and the role of major market makers. If you look at top exchange, you will see familiar names. DWF, Wintermute, GCR, Jump. These aren't just market makers. They are the architects of liquidity. They hold position in hundreds of assets, tighten spreads, and enable arbitrage. Without them, the chart will look like a heartbeat monitor, just sharp spikes and crashes. But there is a downside. When these major market makers leave, the liquidity fades away. And for the retail trader, it just looks like a sudden crash out of nowhere. What to pay attention to in a project? This is why when you analyze a project, you can just look at the tokenomics. You need to see how it's behind the liquidity. If a project completely depends on a certain market maker, it's a dead system. Strong projects build their own economy, where liquidity is supported by the community and real utility, not just by an external provider. Marketing versus product. There is a simple rule. Strong marketing can save a weak token. Look at Blast. Massive hype, but after the listing, the price dropped. Why? Because hype is a short-term driver, not a foundation. When a token has no real utility and everything is held up by marketing, any minor dip can turn into a panic sell. Tokenomics and VC pressure. Now, for the most painful part, why most charts dump eventually? The answer is simple. Unlocks. When a project gets investment from venture funds, those funds have one condition. After a certain time, they can sell their token, usually 6, 12, or 18 months after the token generation event. TGE. As a result, even if demand is stable, the supply increases and the price drops. The VCs take their profit, the market makers stop providing the same level of liquidity, and retail traders are left alone with a falling chart and liquidated positions. Can a market maker hold the price? Sometimes yes, but almost always is a losing game. To hold the price, a market maker has to constantly buy tokens when the market is selling. That's expensive and unsustainable. Most agreements between projects and market makers are temporary. They can fight the market forever. What's the cost? In the industry, there are two main payment models: loan and retainer. Loan, the project gives the market maker tokens and USDT, and they manage the liquidity. Retainer, the project pays a fixed monthly fee to keep the order book active. On average, we are talking tens of thousands of dollars per month. Some market makers also take a performance fee, a cap of the trading volume they generate. But understand this: if a token has no organic demand, no mechanic can hold the price forever. How market makers profit? Their main source of income is the spread and arbitrage. Market makers use HFT, high frequency trading algorithms. They connect directly to exchange through collocation, where the delay is measured in milliseconds. They aren't guessing the market's direction, they are the first to react to any movement. Sometimes exchange even pay them negative fees just to have them providing liquidity. Delta hedging on new listings. When a token first lists on an exchange, market makers hedge their risk. For example, if they are holding a large amount of the project's tokens, they might short the futures contract to lock in the price. This is called delta hedging. It ensures them against sudden crashes and volatility. But if the market moves strongly against their position, the losses can stack up. Cross-exchange arbitrage. Another key tool is arbitrage between different exchanges. When the price is higher on one platform than another, the market maker instantly balances. They buy where it's cheaper and sell where it's more expensive. The result is that the price becomes nearly identical across all platforms. This is the market maker's true function: stabilization. Derivatives and risk. In the future markets, there are two indicators every trader must know: open interest and funding rate. Open interest shows the total number of open contracts. If it's rising too fast, it means the market is overheated. Funding rate is a fee paid between loans and shorts to keep the price unsure. If the funding rate gets extremely high, it's a signal the crowd is all on one side and a squeeze is likely coming. Streaming funding. There have been cases where the funding rate hit 1% per day. That's a catastrophe. Traders watch their deposit get drained just by the funding fees, even without their trade hitting a stop loss. And this is another crucial reminder: the market isn't about being right, it's about surviving the long game. Survivor bias and why technical analysis equals astrology. When you are on Twitter and see a trader showing how they perfectly called the button, remember you are seeing survivor bias. For every one of these gurus, there are thousands who lost money and just stayed quiet. Technical analysis is a comforting illusion of control. It makes you feel like you can understand the market. But when the charts are drawn by market makers, algorithms, and wash trading, what are you actually analyzing? A picture that someone else painted for you. How market makers paint the patterns. This is especially obvious on illiquid assets. A market maker can literally draw technical analysis figures. They move the price smoothly, creating triangles and support levels, only to then trigger the stop losses of everyone who believes in them. For retail, it looks like a false breakout. For the market maker, it's just Tuesday. Why 95% of traders lose? Because they aren't trading against the market, they are trading against the people who ride the market. They are analyzing the behavior of an algorithm, thinking it's human psychology. The market isn't a crowd, it's code, liquidity, and market makers who engineer the price movement. You're trying to outsmart the author of the book you are reading. How this all connects to tokenomics. Now, let's put it all together. Good tokenomics isn't just about token distribution. It's about the balance between liquidity, real demand, token velocity, and resistance to VC selling pressure. A token with no utility is just a speculative instrument, but a token with a real function in its ecosystem, that one can survive without artificial pumps. Example, the aliens approach. By the way, at aliens, we're approaching our own token launch, and we have built it considering all these pitfalls. Our token is deflationary with a real utility model. It's not a hype asset, it's a functional tool inside our ecosystem. No painted volume, no fake trades, just real economic logic, rewarding active user, burning fees, and a limited supply. Because a token isn't just a picture on CoinMarketCap, it's the economic code of our project. So when you see a beautiful chart, ask yourself, is this a market or is it a performance? When you see a pump, it is real demand or just an algorithm at work. And when you are investing, always remember, real money doesn't chase candles. It looks for structure, logic, and long-term value. Understanding how market makers, tokenomics, and liquidity are connected, that's the real knowledge that separates a player from just being a spectator in the crowd.